Life insurance illustrations, the glossy brochures that make your retirement look like a yacht in the Bahamas. But are they actually telling you the truth? Today, we're pulling back the curtain on one of the most misunderstood documents in personal finance, and what we find might make you want to read the fine print twice. Here's the thing, an illustration is essentially a sales tool dressed up as a financial projection, and the insurance industry has known this tension for decades. It's like a restaurant menu with photos that look nothing like the actual food, technically accurate, deeply optimistic, and designed to make you order the expensive entree. The catalyst for this conversation is simple. Millions of people have bought permanent life insurance policies, whole life, universal life, indexed universal life, based on illustrated returns that quietly assume conditions that never materialized. The Office of the Insurance Commissioner has documented cases where policyholders watched their cash value evaporate because the non-guaranteed column, the one the agent kept pointing to, was built on assumptions as solid as a sandcastle at high tide. Let's break down what you're actually looking at when an agent slides that illustration across the table. There are two columns that matter most: the guaranteed side, which is the worst case contractual minimum, and the non-guaranteed side, which is the company's best guess or best hope dressed up in a suit and tie. The optimism baked into these projections was intoxicating in the 90s and early 2000s, when whole life policies were illustrated at dividend rates near 8 or 9%, and universal life products assumed crediting rates that would make a hedge fund blush. Fast forward to today, and those same policies are lapsing because reality stubbornly, persistently refused to cooperate with the brochure. Psychologically, what happens to a policyholder who bought into the dream is a slow, painful recalibration. First confusion, then denial, then the phone call to the agent who has since retired to Florida. As financial educator and author MJ Rose once noted in a different context, we don't buy products, we buy the story we tell ourselves about those products. And life insurance illustrations are nothing if not an extraordinarily well-formatted story. History gives us a roadmap here. The universal life policy crisis of the 1980s and 90s left a trail of lapsed policies and angry policyholders when credited interest rates dropped from double digits to something far more humble. The pattern repeats: new product, compelling illustration, rosy assumptions, reality check, and yet each generation of buyers seems genuinely surprised when the cycle completes itself. One of the most persistent misconceptions is that the illustrated rate equals the guaranteed rate, when in fact, for most permanent products, the guarantee sits at the absolute floor, sometimes as low as 2 or 3%, while the illustrated rate is purely hypothetical. Understanding this isn't pessimism, it's literacy. The same way knowing that a weather forecast is a probability, not a promise, doesn't make you afraid of weather. It just makes you carry an umbrella. So what do you do practically? When reviewing an illustration, always stress test it. Ask the agent to run the numbers at the guaranteed rate, at half the illustrated rate, and at the current dividend or crediting rate, and then compare how your policy performs across all three scenarios. If the policy only works in the rosy column, that's not a plan, that's a wish dressed in a three-piece suit. The actionable lesson history teaches us is this: discipline in evaluating the downside scenario protects you far more than conviction in the upside projection. Position yourself for the guaranteed reality while hoping for the non-guaranteed upside, not the other way around. Because patience and process will always outlast optimism and timing. There is actually something liberating about sitting across from an illustration and knowing exactly how to read it. You're no longer a passenger, you're the driver, and the fine print stops being intimidating and starts being informative. The people who get burned are almost never the people who ask too many questions. They're the ones who trusted the pretty chart without asking what happens when it's wrong. Philosophical reflection time. Discipline in financial decisions isn't about being pessimistic. It's about being honest. Honest with yourself, honest about assumptions, and honest about the gap between what's sold and what's delivered. Consistency in asking the hard questions. Sizing your premiums appropriately so a worst-case scenario doesn't wreck your budget. And staying unemotional about the sales pitch, that's the whole game. If you already own a policy, Get an in-force illustration today, not the one from when you bought it, but a current one based on today's assumptions, and compare it line by line to what you were originally shown. You may be exactly on track, or you may need to course correct, but either way, knowing is infinitely better than not knowing. The irony of life insurance illustrations is that the product itself, protection, tax-deferred growth, legacy planning, can be genuinely powerful when sized correctly and evaluated honestly. Yet the illustration process has historically undermined trust in the very product it's trying to sell. Read critically, ask relentlessly, and let the guaranteed column be your anchor, while the non-guaranteed column remains what it has always been, a possibility, not a promise. Whether you're evaluating a new policy, revisiting an old one, or just trying to make smarter decisions with your money, we're here to help. And if you're also looking to get started in real estate investing, need home contracting work, or want to connect with lenders, check out our links in the description below.